welcome back to my favorite channel. Right now, I want to share about basic principles of trading strategy. Basic principles of trading strategies, geometry of the golden rectangle and the golden sections. The famous Greek mathematician Euclid of Megara was the first sections to write about the golden sections and to focus the analysis of a straight line. The more complex structure of the geometry of a golden rectangle is shown in figure 3.3. The ratio of the long side of the rectangle divided by the short side of the rectangle has the proportions of the Fibonacci ratio 1618. Figure 3.2. The rule of alternation shown in the sunflower source, the new Fibonacci Trader workbook by Robert Fisher. New York, Wiley, 2001. Figure 3.3. Geometry of the golden rectangle. 15 Parthenon Temple in Athens. The proportions of the Parthenon Temple in Athens bear witness to the influence of the golden rectangle as well as the golden sections on Greek architecture. The proportions of the Parthenon Temple fit exactly into a golden rectangle. Its total width is actually 1618 times its height. Other geometric curves that are important to humankind are plentiful in nature. The most significant to civilizations include the horizon of the ocean, the meteor track, the parabola of a waterfall, the arc that the sun travels in the sky, the crescent moon, and the flight of a bird. Many of these natural curves can be geometrically modeled using ellipses. The latter finding leads into a brief description of trading tools that use the Fibonacci ratio. A basic knowledge of the corrections and functions of these tools is necessary to understand the trading strategies that are introduced late in this book. Introductions of the Fibonacci trading tools, corrections in general. For corrections with Fibonacci-related trading tools, an impulse wave that defines a major market trend upward or downward will have a corrections wave before the next impulse wave reaches new territory. This occurs in both bull market and bear market conditions. Analysis would be easy if we couldn't detect a single general pattern of corrections. The problem is that there can be many more price figure. Parthenon Temple is Athens. Patterns than impulse wave in the commodities futures, stock index futures, stocks, or currency markets. Markets move sideways for a longer period than an impulse wave appears. We can never predict which of the next waves will be an impulse wave instead of another false move in continuations of a sideways market. 3. For every serious trading approach, using corrections has to be designed to survive even the longest sideways market correction phase. No market pattern can assure a profitable trade. At any time, we can be in a correction of an impulse wave or at the beginning of a new impulse wave. Trading with corrections is a trend following strategy. It is based on the assumptions that after a correction of an impulse wave up or down, the next impulse wave will follow in the directions of the simple first impulse wave after the corrections is finished. Thus, we generally expect a minimum of a 3 swing price move, and in many cases, this assumption is correct. Therefore, working with corrections is a valid investment strategy, and it is discussed in detail later in this book. Corrections work equally, we long or short, to the upside or downside of the markets. The worst thing that can happen in trending markets is that the market may run away without correcting a knock and without leaving a valid signal. Markets moving sideways involve the risk of the trader getting stopped out in a streak of losing trades in the strategist parameters are too restrictive. Trading with corrections is a short-term strategy. The goal is to have many trades, of which a large number are profitable. Likewise, there should be a low number of losing traders, and this should be small loss. Corrections are closely related to the Fibonacci ratios to the swing size and volatility of a product. Which ratio to choose depends on the product and the time interval selected. Weekly data might need different ratios from daily or intraday data. The safest way to find the best ratio for products and time spent is to test them on historical data with a computer. The most common approach to working with corrections in research and practical trading is to relate the size of a correction to a percentage of a pure impulse wave. For Fibonacci's PHI, the following prominent percentage of possible market corrections can be derived directly from the ratios. Forecast the exact size of a currency is an empirical problem. Investing after a correction of just 30% might be too early, whereas waiting for a correction of 61% might result in completely missing a strong trend. But no matter what corrections are considered, trades should focus on the PHI-related size. Price extensions in three-wave patterns. Price extensions are exuberant price movements that result from runaway markets, opening gaps, or limit moves up or down at high volatility. Most extensions occur when unexpected news such weather information, crop reports, or interest rate announcement by the Federal Reserve Board reverse major market trends within seconds. When news runs counter to investors' expectations, market situations emerge with strong trading potential. However, investors can only take advantage of these situations if they follow it sensibly. definitive rules in carrying out analysis. Extensive market moves can be very dangerous for investors who get caught by surprise with wrong positions in the marketplace. Extension take place primarily in the third wave of a three-wave pricing pattern. In a regular three-wave pattern in an uptrend, the correction does not go lower than the bottom of wave 1. In extensions, out of a bear trap formations of irregular bottoms, the corrections can go lower than the low of the first impulse wave, opposite in a bull trap. The two basic chart formations for price extensions are illustrated in Figure 3.6. Exploring price extensions means investing against major trend directions. Working week extensions also suggests that an investor is looking for quick profits by taking advantage of imbalances in the marketplace. Therefore, it is important to know in advance not only when to enter a position, but also when to exit it. Entry rule, stop loss rule, and profit target always must be integrated to achieve long-term investment strategies that are consistently profitable. Three consecutive analytical steps are needed to calculate price targets in price extensions of the third wave out of a three-wave chart formations. A minimum swing size has to be defined for the size from peak to valley or valley to peak of the first impulse wave of the three-wave pattern. The swing size has to be multiplied by the Fibonacci ratio 1618. The resulting value is added to the size of the initiating swing to define the price target. Figure 3.7 illustrates these steps. Sophisticated investors who want to explore fast markets can easily follow the basic principles of extensions in three-wave patterns and extend the rules into five-wave price patterns. Price extensions in five-wave patterns. When analyzing price extensions in a five-wave patterns, we look for an additional parameter from the Fibonacci summation series to confirm our price targets. Calculating for extensions out of a three-wave pattern based on the 1618 ratio. To analyze a three-wave price pattern, we multiply the size of the first impulse wave by the Fibonacci ratio 1618. The product is then added to the swing size of the initial move to calculate the Fibonacci price target line. It is this Fibonacci price target line that we expect the third wave to reserve. Until here first for today. See you in the next video. Bye bye bye.